After the last video, we got so many calls, so many messages asking whether we can buy an investment property as a first-time home buyer or not. So in today's video, we'll be discussing about pros and cons of buying your property to live in versus to invest in. So let's get started. We'll be talking about three things in this video. Number one is, can I buy an investment property as a first-time home buyer? This is a really important question to answer because there are certain rules and policies that actually make it a lot more difficult to buy the first home as an investment property. And there are certain things that you lose while doing that. Then we'll talk about the numbers, whether it makes sense still, despite the policy, despite the rules, despite, certain challenges. Is it still worth buying your first home as an investment property, which means that you still rent your house? Like you are still renting, and then you are buying a house where other tenants actually pay your mortgage and other expenses. They pay you a rent. Now, of course, after looking at all the pros and cons, the policies, the numbers, you might get a little bit confused for your situation. So therefore, in the end, we'll be discussing about the questions that you need to ask yourself in order to determine or decide what to do for yourself, whether to live in that house or to put it on rent. First, the question is, can I buy an investment property as a first-time home buyer? And the answer, of course, is yes. However, there are certain things that are a must do. First is you need 20% down payment. And even if you are a first-time home buyer, I have said this many times, if you are buying to live in that property, only then you can do a less than 20% down, the minimum 5% down. But if you are buying an investment property, despite you being a first-time home buyer, you will still have to do a minimum 20% down. And there is no exception to this. The second thing is that if you are going to a big bank like a TD, a Scotiabank, one of the top 5 banks, which is A lenders, people also call that A lenders. If you are buying your first house as an investment and you're still renting, you'll need $50,000 or 10% of property value as net worth. What that means is after you have done your 20% down payment and your closing cost, you still need to show $50,000 or 10% of the investment property. Let's say you're buying a $600,000 house, you need $60,000 in your bank account as liquid assets. Now, you don't need it as savings. You can have it in stocks, but it needs to be liquid so that it's available to you. The reason why there is a condition of this is because if you're buying an investment property, there is more risk. If the tenants break that property, you should have enough money to fix it and not default with the bank. And therefore, the bank is covering their backside by putting this condition in when you're buying an investment property without owning your own. And the third policy condition that makes it a little more difficult to buy an investment property is the rent that you're paying right now. Let's say you're buying an investment property and you're putting tenants in, but you're still renting a home because you don't own your home. Your rent in that place that you are living in will be added to the liabilities. It will act like a car. So if you are paying $2,000 in rent, that $2,000 will actually go into your liabilities, and that will just put off the ratios and your eligibility just goes down the drain. Now, the last two rules are more stringent when you are going to the bank. So therefore, it makes it very difficult for people to qualify with banks and prime lenders and A lenders. And therefore, we have to go to something called as a B lender. I've talked about this on this channel, alternate lenders, where the interest rates is almost 0.5 to 1% higher. And you also need to pay a lender fee, which is 1%. So that's the number one downside of buying an investment property without owning your own home. The second one is you lose incentives. So for example, you cannot withdraw from RRSP, which is the home buyer's plan, because you can only withdraw money up to $35,000, which I've talked about in the previous videos. You can only do that if you're buying your primary home. Same goes for FHSA. This is a new account where you can put $8,000 every year. If you're a couple, you can do $8,000, which is $16,000. You get the taxable benefit, but in order to withdraw that money, it needs to be your first home that you live in. And similarly, if you're in Ontario, you get a land transfer tax benefit of $4,000 for your first home. But again, it's only if you are living in that house. So you lose all these incentives when you're buying your first home as an investment property. And the third and probably the biggest drawback is that you lose future eligibility to buy your own home. So what I mean by this is that let's say you buy a house right now for investment purposes and you want to keep that house, and now you want to buy your own house, let's say 3 years down the line. Now, depending on your income, you might not qualify for a very big house because you already have one which is part of your liability. So either you have to sell that, pay the capital gains, and then buy a house, which is not an entirely bad thing. And I'll be talking about that in the subsequent slides as well. However, it will impact your future eligibility if you want to keep both the houses, the one that you have bought for investment and the one that you're buying for yourself. Now, there's another opposition that I get from a lot of people when I talk about this, when we are having calls with clients is that what if my office is in downtown, I have to go to the office, so I cannot just, move to London or Windsor where I can actually afford the house. What if I lie to the bank and say that I'm going to live in the house, but I actually don't? And the thing with that is the banks are not stupid, and you can actually lose it all because there are certain safeguards that are in place with the bank in order to catch this lie. The first one is if you're doing a 10% down payment and you're saying that you are living in that house, but you are buying more than 100 kilometers away from your workplace, they will need a letter of employment stating that you can work 100% remote. And if you do not have that letter of employment, and if the employer is not agreeing to that, the mortgage will not be funded and you'll lose your deposit and you will not be able to close on the house. Now, in the last 2 years, there are so many people who have come to me after getting screwed by the bank. And the reason was this. Because the bank said that you can buy a house in Windsor while you're working in Toronto, but that's not possible and that's stupid. That no one should be doing that, right? It doesn't make sense. And the only reason why you're allowed to do a less than 20% down is because you live in the house. And honestly, you really can't do anything because this is an insured condition and you can't go around it. Now, the other lie that I hear a lot is that what if I'm buying in Mississauga and I'm living in Toronto and I want to keep living in Toronto, but I want to rent out my Mississauga house while I buy this with a 10% down payment, telling the bank that I would live in the house, but actually I won't. And the problem with that is that you expose yourself to insurance fraud, because when you're getting a fire insurance done for the house, let's say you did a 10% down, you told the bank that you're going to live in the house, you have to get an insurance in line with what you told the bank, which says that I will live in the house. It will be an owner occupied house, and the tenants move in and there is something that happens to the house and it catches fire. And in that case, when the insurer comes, they'll say that you said that you will be living in the house. I can see that the tenants are living. You lied to us and therefore we will not give you any insurance money. And then let's say your loan is $480,000 or $500,000. You are under by $500,000. You owe the bank $500,000. The insurance is not paying that money because you lied to them. And that at a minimum would put insurance fraud on your record. And you might have to file for bankruptcy because you still owe the bank $500,000 that no one is paying you because you lied to the insurer. Now, on the flip side, you might also say that, oh, I will just tell the insurer after I get my fire insurance, after I close my house, that now I'm putting it on rent. And then there's a risk that the insurer will have to tell the bank as well, because bank is one of the beneficiaries of the insurance, that this person is no longer living in the house and they are renting. And then the bank has the right to cancel the mortgage. There are a lot of nitty-gritties that we don't understand, and there is no reason why we should take risk on such a massive purchase. So do not do that. There's no point of lying. There are safeguards in place and you might find yourself into a lot of trouble if you do this. Now, I know this is all a lot of doom and gloom, but this is all policy. But now let's look at the other way. When you have the 20% down payment, but you cannot buy to live in it because your job is in Toronto, you cannot afford anything in Toronto, and now you want to buy, let's say in Calgary, because the cash flow is making a lot more sense. Now let's look at the numbers on that, because interest rate, like I said, will be a lot higher. You will have to pay a 1% lender fee, but maybe the numbers will still make sense. So let's look at the numbers. So let's say this is a property in Calgary. It's a rental purchase. Your purchase price is $600,000. It's an up and down duplex. So your basement can also be rented. The upstairs can also be rented. And you are doing a 20% down payment. So you're taking a loan of $480,000. And then you're paying 1% lender fee plus closing cost, which is about $5,000. Plus in Calgary, the closing costs are less than $2,000. So you're spending $7,000 upfront, apart from the $120,000 of down payment that you're doing. Let's say these are the numbers, right? And the interest rate for this one is 7%, because now we are going to a B lender, an alternate lender, and the interest rates are usually higher. The mortgage payments will be a lot higher. The amount of principal that you're paying, the principal payments that you're doing, that will be about $500, and your overall payment, let's say, is $3,161 at 7% for the $480,000. Your overall expenses on this will be property tax, insurance, maintenance plus vacancy. You have property management. So all this will account for, more cost and more expenses. And overall, you are paying mortgage plus expenses, which includes the mortgage and everything that we discussed. Now, do take property management if you're buying a house which is very, like you're living in Toronto and you're buying in Calgary, so it's very far. So it's important to, do property management as well, or have a professional property manager, manage the property. Your overall expenses will be about $4,000, and the rent, as per the rent that I am getting for my duplex, is about $3,500 plus utilities. So your cash flow negative for the first year will be about $500. Now let's assume that in this case, you are also renting in Toronto and then you are having a cash flow negative of $500. Let's say your rent is $2,500. Let's say it's $3,000. Overall, you are paying $3,000 in rent and $500 negative cash flow on that property. So overall, it's $3,500 for the cost of ownership of both the, maintaining the rental property and maintaining the house that you are living in on rent is $3,500. And if you are buying a house in Toronto, you'll be paying a lot more than that in overall expenses for that house. So make that calculation, talk to a mortgage agent, talk to me, book a call from the description, and we can do the numbers together. If you have the 20% down payment, that's a prerequisite. I'm saying it again, but it might make sense in your situation, depending on what your situation is. And we'll be discussing that in the next slide as well. For year 2, let's say the rents increase by $200. That's a very conservative increase. There's no rent, rental control in Calgary. So you can actually increase the rents if the market rents are increasing, and your cash flow negative will become minus $300. And for year 3, the cash flow negative will become you'll be cash flow neutral, about $100 negative. And let's say in 3 years, the home value has increased 5% every single year, and it's about $700,000 now. And the outstanding loan, you have actually paid it down to about $461. It won't be paid down to a lot, honestly, because the interest rate was so high, but you did build an equity of $234,000. And remember, you only did $120,000 down. Yes, you paid 1% lender fee as well. Overall, let's say $130,000 of upfront, and you are $100,000 up on equity alone, in 3 years. And then what would happen is the interest rates will actually go down, and then your mortgage is up for renewal, and the interest rates in 3 years are, let's say, at 5%. And I'm taking a very, very conservative estimate. The 25-year average of interest rates is less than 4%, but I'm still taking 5% interest rate, which is 2% lower. Your mortgage payment will reduce by almost $500 to $600. Your overall expenses will increase a little because of inflation, but overall, your mortgage plus expenses will still be between $3,500 to $3,600, and that would make you cash flow positive in year number 4 because the rents have again increased by $200, again a very conservative estimate, and your cash flow is over $500. In year 5, the cash flow has increased again to about $700, and in year 6, you'll be very close to $1,000 cash flow. Plus, in 6 years, your property value is now $800,000 using the same 5% principle of 5% year-on-year increase. And yes, it can go down for a year or two, but long term, you'll always be positive in real estate because of the scarcity of this particular asset class. And your equity, because you have paid the mortgage down more, and this time the tenant actually paid for the entire thing, your equity in the house will be over $300,000, $365,000 to be exact, if you are to believe that the property value increases 5% every single year for the next 6 years. So if you've seen my previous video where I did the calculations for the rental purchase as well as for the primary house, you would know that this logic will still work if you buy your first property as an investment and you're paying a very high interest, but it will all depend on the strategy that we build together in order to make these numbers work. But in order to decide whether to buy a property to live in it or to invest in, you need to ask a few questions, and that will make things very clear. The first question is, are you ever going to buy your own house to live in? And if the answer is yes, and if you say that yes, in a couple of years I'll buy a house, then I'll recommend that you save for that first and buy your own house with the money that you have. And the reason for that is that your eligibility will reduce if you already have a rental property. And let's say in 3 years you want to buy a house and then the house prices are very high, you will probably not be eligible, and you'll any which ways have to sell the rental property in order to buy that property. So if you have the money right now and if you are looking to buy a house anyways for yourself to live in the next couple of years, I would recommend that you do that now if you are financially stable. The second question to ask is, are you going to leave Canada at some point? And contrary to popular belief that yes, I am willing to leave Canada. Let's say I want to go back to India or I want to move to US in 3 years. And you say that I'm not going to buy a house because I want to do that. But it's the other way around. If you are willing to leave Canada, then what would happen is all the appreciation that you have had in your primary home, you can actually pay $0 of capital gain tax because it was your primary home in Canada, and you can take all the capital gains with you wherever you go, and there's no tax implication. Now, of course, you need to talk to your accountant when you're doing that. I'm just a normal guy on YouTube who's saying that. But if you are leaving Canada, at some point, it is worth considering buying your primary house because there's no capital gain on appreciation when you sell your primary home. However, if you buy an investment property, you will have to pay capital gain tax. The third one is, do you qualify to buy close to your work? So let's say you're living in Toronto in the previous example and the houses here are on average $800,000 to $900,000 and you just can't afford it because you're only making $100,000. And in that case, if the answer is yes, and you really want to invest in real estate and you're not looking to buy your own home in the next 3 to 5 years, then yes, it's worth considering buying in a place as an investment property where the upfront investment is low and the qualification will be a lot easier. And in that case, I'll recommend you book a call and we strategize on the way forward depending on your situation. And the fourth and probably the most important question, and I'll say this many times, is do you have 20% down payment? Because if you don't have 20% down payment, even for the investment property, there's no point going down this rabbit hole. There's no point having the discussion. If you do not have the 20% down payment, you cannot buy your first home as an investment property, plain and simple. So on the flip side, let's talk about the advantages of buying a house to live in. And the number one advantage is you build equity in your home and pay down the mortgage over time. So let's say in 30 years, if you want to retire, if you have a house today, in 30 years, in 25 years, it will be paid down fully and you will be mortgage free. And that's a really important thing to do if you have a long-term plan of living in Canada. A few months ago, I made a video on renting versus buying. Do check that video out and you'll get some more clarity of what I'm talking about. Second, and of course, if you're buying your primary home, you're living in that house and therefore you can do a less than 20% down and there's no stopping you doing that. Then you can use all the first time home buyer incentives you can draw from RRSP to buy the house. You'll get land transfer tax benefit if you're buying in Ontario. All those will come into play if you're buying a house for you to live in, your first home for you to live in. And last but not least, there is 0% capital gain tax when you sell your primary home, and it ties back to what we discussed in this, where you are leaving Canada at some point. You can actually sell the house and just take that money with you and buy a house where you are going, or just keep all the capital gains and retire yourself. That's all I have for today. I hope you liked this video. I hope there was some clarity. I think there was a lot of confusion in the last video. I got a lot of calls where people were confused. Oh, can we buy our first home as an investment property because the numbers made sense? But there are certain policies with the big banks that don't allow us to do that. However, there are certain instances and certain questions that you need to answer for yourself and it could still make sense, and we have lenders who can still do this. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।